So I'll give you 2 minutes just to go through the question and just make sense of the question, right? It's say the following are the abridged statement of financial position of A Limited and its subsidiary B Limited, right? So who is the parent company? Is it A or B?
A is the parent. A Limited is the parent company.
Yes, thank you. A Limited is a parent company and B is a subsidiary. Good. And they've given us the financial statement as at 31st of December 20.6. Good. So let's see what information we have. So I want you to go through it, understand whatever has been given to you, and also calculate the percentage interest and see if you'll be able to calculate it. Okay, so that is the statement of financial position that has been given to us. Then we have, okay, so looking at the statement of financial position, is there any amount that you are going to eliminate? So you have property, plants and equipment, you have investment in B Limited, you have trade and other receivables, you have share capital, you have retained earnings, and then trade and other payables. Is there any one of these that you are going to eliminate? Because it's a transaction with each other. So you can see, you understand the principle of elimination, right? That any transaction between the parent company and the subsidiary needs to be eliminated. It needs to be nullified. We need to cancel it, right? So you can see that in this question, there's investment, right? And there's also the share capital, right? So we debit the share capital and we credit the investment. Then we debit the retained earnings. Yeah, so basically you debit share capital, debit retained earnings, and credit the investment in B Limited. And do you understand why we do that? Do you understand why we debit the share capital and we debit the retained earnings and credit the investment? Okay, so then what actually happened was that when A, which is the parent company, came to purchase B, which is a subsidiary, right? The entry that the parent company will have passed in their own financial statements was to debit investment in B Limited, because remember, the parent company has gone to buy or has gone to purchase an investment. Whenever you purchase an investment, what is the journal entry? You purchase an investment. So A, being the parent company, has gone to purchase an investment in B Limited. So you say debit investment of 148,000. That's what A Limited, which is the parent company. That is the entry they will pass in their own individual books. Debit investment 148,000. Credit bank 148,000. And then because why? The parent company has gone to buy an investment, or they've gone to buy shares in a company, which is an investment. Whenever you buy anything in accounting, whenever you buy anything, you debit that asset that whatever you bought, and you credit bank because you bought it with cash, right? So if I buy a book, it's debit book, credit bank. If I buy stationery, it's debit stationery, credit bank. If I buy a TV set for my company, debit TV set, credit bank. So it's the same thing. When the parent company went to buy some shares in S Limited, he passed a journal entry. Debit investment 148,000, credit bank 148,000. Right? Because the holding company had a transaction with S Limited, the subsidiary. The subsidiary also has to pass an entry in their own individual financial statements, right? And what entry would they pass? B would say debit bank, because they've got money out from the investment that the parent company purchased. When the parent company purchased the investment, the parent company gave them money. So they will debit bank 148,000, right? What did they have to give up for them to get that money, that cash? They gave up their shares and they gave up their retained earnings, which is what the net asset value of the company. So the subsidiary company will say debit bank 148,000, credit share capital, because they gave up share capital. They issue shares of how much? Of 80,000. And then credit what? Retained earnings or retained income of how much did they tell us at the beginning when it was acquired? So A Limited acquired its interest in B Limited on 1 January 2020, at which time this limited retained earnings amounted to, yeah. So at the date of acquisition, B's limited retained earnings was 26,000. So we credit retained earnings 26,000. That's our general balance. The general entry in B Limited as a balance. You have a debit of 148,000, a credit of 80,000 plus 26,000. So let's add the credits together. The credits is 80,000 is 80,000 plus 26,000, giving us 106,000. So the debit, which is the bank, is 148,000. But the credit, if you add the share capital and the retained earnings together, we are having 106,000. Our journal does not balance. There has to be something that is still missing, right? And what is that thing that is still missing? It must be. What do you think will make our entry balance? So we have a debit bank of 148,000, debit credit share capital of 80,000, credit retained earnings of 26,000. Our journal doesn't balance. The debit side is more than the credit side. Debit is 148. That's debit bank, and then the credit is 106,000. So what do you think is missing to make our journal to balance?
We've got Melody now, Gordon. I don't know what happened to.
We've got. Oh, okay. Sorry.
No problem. Hello, Melody.
Melody, how are you?
Hello, fine, and you? Thank you.
Fine, thank you.
Yeah. Okay. Cool. So, Melody, we were looking at the question that we did yesterday. Okay, no, we didn't. We did one question on study unit. One major question on study unit 4, and then there was another one that we couldn't get to. So I want us to finish that question before we look at study unit 5. Right. So that is what we are looking at. So if I should just project, so we're looking at a company. The following an average statement of financial position for A Limited and its subsidiary B Limited. Good. So who is the parent company and who is the subsidiary? Who is the holding company?
The holding company is A Limited and the subsidiary B Limited.
Good. Good. A is the holding parent company and B is the subsidiary. Good. And they've given us their financial position as at 31st of December 2020 of both the parent company and the subsidiary. And they tell us that property, plants and equipment 160, 180. Investment in B 80,000 ordinary shares for it was costing 148,000. Trade and other receivables 90 and 90. Share capital ordinary shares 100,000 for A and 80,000 for B. Retained earnings 120,000 and 60,000. Trade and other payables 178, 130,000. Will you be able to calculate the percentage holding that A has on S? the percentage holding. Will you be able to know to calculate it?
Yes, I would say it's 80,000 ordinary shares. Investment in B Limited is 80,000 ordinary shares, and the share capital of B Limited was 80,000 shares. So it's 80,000 divided by 80,000, then we get 100%.
Good, 100%. We get 100%. That means the holding company A Limited holds 100% interest in S Limited, 100%. Like you've done so well. So that's exactly. Is there, as you look at the statement of financial position, is there any value that you're going to eliminate when you are preparing the consolidated financial statements?
Can I answer?
Yes,
Or
please
there's
answer.
someone-
Please, no,
Okay.
answer. Yes.
Okay. I think we are going to eliminate the share capital,
Yes.
like the investment in B Limited, the 80,000 ordinary shares. We are going to eliminate it. We are going to eliminate the 148,000.
Good. So we are going to eliminate the share capital of 80,000, and we are going to also eliminate the investment. So what will be your journal entry? What will be your pro forma journal entry? Which one am I debiting? Which one am I crediting?
We are going to debit the share capital.
Okay, I'm writing it down.
The
Okay.
100.
For
148,000.
148,000. And what do I credit?
I don't know whether the retained earnings. I think we have also to eliminate the retained earnings.
Good.
We have to debit it again.
Good. So we debit share capital and we debit retained earnings. Excellent. So how much are we debiting the retained earnings for? How much are we debiting the retained earnings for? So we are debiting, you said we debit the retained earnings. How much are we debiting retained earnings for? Anybody? Wait, you. Masoti is also here. Anybody? We are eliminating. So I want the journal entries to eliminate the acquisition pro forma journal entry. What am I debiting? What am I crediting? So we've got the statement of financial position, and we want to put down the pro forma acquisition journal entry to prepare the consolidations. And I'm depending on you to give me the pro forma journal entries. What would that be?
I think we have to debit the retained earnings at the date of acquisition, the 26,000 rands.
Good. Debit retained earnings at date of acquisition, 26,000. Excellent. And what else do we debit? Oh, yeah. Okay. So the entry. So we are starting the entry. Debit retained earnings, 26,000. What else? You always debit the retained earnings at the amount at the date of acquisition. The amount at the date of acquisition. Good. So it's 26,000. What else do I debit? I'm preparing the pro forma consolidating journal entries. What else do I debit? Okay, what do I credit? What am I crediting then? So when I look at my statement of financial position, as you can see, there are certain items that I need to eliminate them on consolidations. So I was asking, what are they? So you have your statement of financial position. You have property, plants, and equipment for the parent company, which is A Limited, and for subsidiary, which is B Limited. Then you have investment in B Limited, 80,000 ordinary shares, costing 148. Then you have trade and other receivables. You have share capital of 100,000 and 80,000 for parent company and subsidiary respectively. Then you have retained earnings, 120,000 and 60,000. Then you have trade and other payables, 178 and 130,000. Based on the statement of financial position that you see in front of you, will you be able to give or produce the pro forma journal entries to eliminate the things we need to eliminate? Remember, we said you cannot transact with yourself. So any transaction that the parent company has performed with the subsidiary, we need to eliminate it on consolidation. So which ones do we eliminate? Anyone has said anything on the chat? Okay, so Melody says investment in B Limited. Okay, so give me the entire journal entry. I want the entire journal entry. One of them is investment in B Limited, but I want to tell me debit this, credit this, debit this, credit this. Remember, journal entry has got two sides. There's always a debit and there's a credit. So for the investment, am I debiting the investment? Am I crediting the investment? If I'm debiting or crediting the investment, what is the corresponding entry? That is what a journal entry is. You will not get any mark if you are asked to perform a journal entry and you just give one-sided entry to say investment. Investment, well, you need to go a bit further. Are you debiting the investment? Are you crediting the investment? If I'm debiting or crediting, how much am I debiting it by? How much am I crediting it by? And if I debit investment or credit investment, what is the corresponding credit or corresponding debit? You get it? Cool. So what do I debit and what do I credit based on this?
I'm having a challenge to type. Let's see it
Okay,
out.
then speak. Speak.
Okay. I would debit the share capital.
Debit
with,
share capital. How much?
With 148,000.
148,000. I'm writing down everything you say. Then we'll analyze it. Continue.
Then the retained earnings. 20. We will also debit the retained earnings with 26,000.
With how much? 26,000. Okay.
26,000.
How much?
26,000.
Okay, 26,000. Good. I've done that. Okay.
Then we credit the investment in B Limited.
Investment in B of how much?
Of 148,000.
148,000. Good. That's your journal entry balance.
No, then I'll try to balance it. If
good.
Then say 148,000
yes.
plus 26,000.
Yes.
Then I'll get let me see, 148 plus 126. Then I'll get 274. That's all.
No. Well, you made a mistake. 148 plus 26. What do you get?
Sorry.
148
plus
26.
26. Yeah. That's 174,000.
Yes.
Then that so there's a difference now.
There's a difference of how much?
Of 26,000.
Good. What do you think the 26,000 is?
I think it will be goodwill.
Good. It will be goodwill. It will be goodwill. So when you do your pro forma elimination journal entry like this, the first one, when you are debiting share capital, debiting retained earnings, and there's a balancing figure, if it is a wholly owned subsidiary, it's likely it will be goodwill. If it's a partly owned subsidiary, then it's a bit tricky because your balance half a part of that balance goes to the non-controlling interest, and a part may go to goodwill. depending on that is if it's a partly owned subsidiary. But I like the entry you have given me here, right? To say that the reason why I'm passing this entry was that when the parent company A Limited acquired B Limited, A Limited will have made an entry in its own financial statement to say debit investment in B of 148,000 and credit bank of 148,000. That is the entry that the parent company would have passed in their own individual financial statement when it went to acquire, or no, when it went to have it went to acquire a portion, when it went to acquire the subsidiary. Debit investment, credit bank. Like when you acquire anything at all, you debit. If you acquire a book, debit a book, credit bank. If you acquire a vehicle, debit vehicle, credit bank. If you acquire furniture and fittings, you said debit furniture and fitting, credit bank. So the parent also went to acquire an investment. So debit investment, credit bank. That is what they would have passed in their own individual books. Because it had a transaction with a subsidiary, the subsidiary would also have passed an entry in their own financial statement to say debit bank, because they received the money from the parent company of 148,000. What did they give up for them to get that cash? They gave up their share capital. They give them shares. So credit share capital of 80,000. Then credit retained earnings of 26,000. Right? That is what that is the entry they would have passed in their own books. They will say debit bank 148,000. We have received 148,000. What did we give up? We gave up our shares. How much was the shares? It was 80,000. How much was the retained earnings? It was 26,000. Then I asked myself, does this transaction actually balance? No, it doesn't balance. In the subsidiaries financial statement, it doesn't balance because they've received a cash of 148. They've credited, or they receive a cash of 148,000. They gave up shares of 80,000 and gave up retained earnings of 26. There's a 42,000 rand difference. That 42,000, the subsidiary will say what? What is that 42,000 in the subsidiary's books? The subsidiary will say it is what? They got cash for 148,000. They gave up share capital and retained earnings of 106,000. What is the balance? In their own individual financial statement of what would they record as the balancing figure? So in this case, B Limited was selling, right? They were selling their shares. They got 148,000 cash when they sold. So they sold shares and they sold their retained earnings, and they got 148,000 back. What do you think would be the balancing entry for my journal to balance in the books of B Limited? Oh, this is very easy. It's very easy. Whenever I sell something and I get more money than what I'm giving up, what is that thing that I record? Let's say I sell my car and I get more money than the car I give up. What is that? What entry do I record? You record a profit on sale. You record a profit on sale. So in the books of B Limited, they will have recorded profit on sale of share capital and retained earnings of 42,000. That is what they would have done. So you see, when this transaction happened, the parent company passed a journal in their own individual financial statement to say debit investment 148,000, credit bank 148,000 because they went to buy shares or they went to buy an investment, which was costing them 148,000. It's settled, it's done. So when you look at the financial statement, and that is why here, when we look at the financial statement of the parent company, it shows here investment in B Limited, 80,000 ordinary shares at fair value. The cost price was 148,000. Because it comprises what? The shares of 80,000 plus a retained. So even though they didn't mention the retained earnings is included, right? But then you sold it for 148,000. You gave up 80,000 shares and 26,000 retained earnings. So there's still a balance, and that balance goes towards profit on sale. So in the book of the subsidiary, they will have said debit bank 148,000, credit share capital 26,000, credit retained earnings 42,000, credit profit on sale of 42,000 for the journal entry to balance in the books of B Limited. Now during consolidation, we know from our principle that this entry has to be eliminated because it's a transaction between a parent and a subsidiary. That must not happen in consolidations. It's a taboo. It's forbidden. You cannot sell to yourself. You cannot make you and your subsidiary. You are the same company. You are one entity. How can you make a transaction with yourself? So because you cannot make a transaction with yourself, that this entry that you have recorded, that A has recorded in their books and B has recorded in their books, they have to cancel it. We have to eliminate them. We have to nullify them. So the pro forma consolidating journal entry is that whatever A said it was a debit, we credit it. So that is why we credit their investment of 148,000. And whatever B Limited has said is a credit, we debit. So we debit retained earnings of 26,000. That's the retained earnings at date of acquisition, 26,000. We debit share capital of 80,000. And the balancing figure is more likely to be goodwill. But we'll look at this when we look at the analysis. Guys, this is the crux of consolidations. You need to understand this. So if you don't get the rest of the study unit 5 is actually everything that we have studied before. Nothing changed except that this a wholly owned subsidiary, and study unit 5 is a partly owned subsidiary, but it's the same principle. So if you didn't get this, if the whole of when we started studying consolidation, you didn't get anything, you must get this one. It must be clear to you. So show by hands, whoever does not understand, let me do it again. I promise you, this is it. Good, I'll do it again, Melody. Who else? Who else?
Sorry, I have a question.
Yes, please ask me.
I'm kind of confused.
Yes.
So I need clarity.
Please ask. Yes. Ask me. What is it?
Yeah, when we are doing the journal entries,
Yes.
like I see that the debit side it's 174 when you put the share capital and retained earnings. Then the credit side is 148 where we put the investment in B Limited. So does it mean that the good will go to the, because I understand that the good will have to go to the debit side. So I don't know whether the 26,000.
Oh, okay. You know, you have actually answered your own question. You've actually corrected your own question. So the journal entry that was given by, I don't know whether it was Melody. I don't know whether it was you that gave it to me or someone else.
Yeah,
but
I gave it to you.
You gave it to me, but we don't debit share capital of 148. The share capital was actually 80,000.
Oh, okay.
Yeah, you understand, because if you look at the statement of financial position, the share capital was 80,000, not 148. Yeah, so not 148. So it was a debit share capital 80,000, debit retained earnings 26,000. When you add it, you get what? 106,000, and you credit you credited share capital of 148. When you subtract 148 from 106, you get 42,000. So it means that what the goodwill was 42,000.
Oh, okay, I get it. I
You
get
get it, right?
where I went wrong. Yeah, thank you
Yeah.
very much.
Good stuff. Guys, I'm going to do this again. This is the most important thing in consolidation. This is it. Is elimination, because there are two steps to prepare consolidations. The first one is what? You join the assets, the liabilities, the equity, the income, the expenses of the holding company and the subsidiary. You join them together, you put them together. So it's like adding A plus 1 plus 2. So you add them together. Now that one, even grade 1, anyone can do it. Then the second stage is what? To eliminate any transaction that has happened between the parent company and the subsidiary. That is all what consolidation is about. I join together, I eliminate. That is it. So you need to understand the principle of the elimination. Why am I saying debit share capital? Why am I crediting investment? Why am I debiting goodwill? Why? Why? Is the why that makes you get 100% and somebody that does not pass? Because you understand it. So whenever you get a consolidation question, the first stage, join them together. Add so for example, in this question, property, plants and equipment in consolidation 160,000 plus 180,000. Investment in B, 148,000 plus, there's nothing there, so plus 0 for B Limited. Trade and other receivables, 90,000 plus 90,000. You are performing. That's why it's called consolidating. The word consolidate means join together. That's what consolidate means. Join, combine, join together. So I join the income, expenses, asset, liability, equity on a line by line basis, joining them together. I go to share capital. 100,000 of A plus 80,000 of B. I go to retain earnings. 120,000 and of A, 60,000 of B. I go to trade and other payables. 178,000 plus 130,000. So I'm adding A and B together. That's the first stage. The second stage is that you now eliminate any transaction that has happened between the holding company, I like to use the word holding because when I was studying, it was all about, we used to use the word holding company. Yeah, so it's the parent and the subsidiary. The parent and the subsidiary. Any transaction. So we see here that when A came to acquire B, there was a transaction between the parent company and the subsidiary when A initially acquired B, right? That transaction has to be eliminated. And how do I know what to eliminate? I only know what to eliminate unless I know the entry I passed in my own financial statement. Remember, when you are preparing for consolidated financial statement, you have your own financial statement as the parent. Then the subsidiary, you have your own financial statement as a subsidiary. Then when you come and prepare consolidated financial statement, you join them together, right? A plus B on a line by line basis. Then you eliminate. But the only way I will know what to eliminate or I will know the pro forma consolidation entry is only if I know the entry I passed in my own books. Because if I don't know what I did, how will I eliminate it? I need to know what I did. So that is why, so even though we don't mark the entry that the parent passed in their books, and we don't mark the entry that the subsidiary passed in there, we're supposed to do it as a rough, like when you get your question paper, you say to yourself, okay, so what entry will A have passed in their own individual books? What entry would B have passed in their own individual books? Okay, this is it. Okay, then let me reverse what they've done, right? So for example, if A had a transaction with B and A said debit accounts receivable 10,000, credit sales 10,000, and this entry was with a subsidiary, I need to reverse it during consolidation. I need to debit sales of 10,000. Sorry, I need to debit sales of 10,000 and credit accounts receivable of 10,000. I've reversed that entry. Do you understand? When I reverse that entry, it means what? I've eliminated that transaction. I've nullified it. I've made it zero. Because it's the journal entry that accounts for a transaction. But if I reverse the journal entry, it means that I've nullified it. I've made it non-existent. It doesn't exist anymore. So what we mean by eliminate during consolidation means that take it out, nullify it, as if it never happened, because you cannot transact with yourself. You, the parent, and the subsidiary, you are one and the same entity. That's how we see you. We see you as one and the same entity. Yeah. So that is how it is. So if I pass a journal entry to say debit bank of a 50,000 and credit purchases of 50,000, and this is a transaction between me, a parent company, and my subsidiary, I need to reverse this transaction. I need to say, on consolidation, I need to say debit purchases 50,000 and credit bank 50,000. I need to nullify that transaction. I need to take it out. I need to reverse it. So that's what I'm doing here. So the only way I'll know what to debit, what to credit is if I know what I processed in my own book, what I process. And this principle will never change. When you go to third year, when you go to honest, it's the same thing. And remember, third year and honest level, consolidation is everything is consolidation, I promise you. Accounting, because when you go to any big company, a company that you work for probably has got other company it has acquired. Even if it doesn't have a subsidiary, it probably has an associate, or it has a joint venture, or it has other company that it is associated with. So consolidations and joint ventures and associate are going to be part of your life as an accountant. So you must understand it so that you'll be able to treat it and account for it correctly. Right. So that's the reason why. So I'm trying to explain. So when the parent company A went to acquire B, right? Don't forget about consolidations now. Think about the fact that A Limited, a parent, is going to make a transaction with with B company, and they're going to acquire what they're going to buy. They're going to buy B, or they're going to buy some shares in B. So A will have said in their own financial statement, they will say, okay, I'm buying shares, debit investment, or debit share, or debit investment in B, whatever, however you want to call it, 148,000. Credit what? Credit bank, because I use money to buy credit bank. 148,000. Right? Did I do this transaction alone? No, I did it with somebody. I did it with a subsidiary. So the subsidiary also will have also passed an entry in their own financial statement, right? Because they also had a transaction with me. So they would have said, oh, okay, debit bank, because I got money from this from the fact that I sold my shares to the parent company. So debit bank, how much did I get? I got cash of 148,000. Good. What do I credit? What did I give up? What did I give up? Whenever I sell something, it's always debit bank and credit something. If I sell inventory, it's debit bank, credit inventory. I've got money from the sale, but my asset has reduced because I've given my asset away. I've given my inventory. So how do I show that I've given up asset? By crediting the asset, right? So I credit. What did I give up? I give up shares. I credit share capital of 80,000. Now also credit. I also gave up my retained earnings of 26,000. And I said, oh, okay, I got cash of 148,000. I only give up share capital of 80 and retain earnings of 26. So that means I've made profit. Wow. So credit profit on sale of 42,000. That is the entry that B Limited, as a normal company that exists on its own, right, will have processed in their own financial statements or in their own books. Do you understand this? We are going step by step. The first step is that you account for this transaction in the individual books of parent and the subsidiary. Then after you have done that, you say, okay, but wait a minute. So during consolidation, you say, oh, wait a minute. I did this and I did this. But during consolidation, I know I need to eliminate them because I cannot transact with myself. So whatever I debited, I'll credit. Whatever I credited, I'll debit. Don't touch bank. Bank is always a balancing figure. So look at the other accounts. So in the book of A Limited, you debited investment. So you need to credit investment as a consolidating journal entry or a pro forma journal entry. You, in the book of the subsidiary, you credited share capital. So you in consolidations, you need to debit it. You also credited retained earnings. In consolidation, you need to debit it because you are reversing that transaction. And then you credited profit on sale. In consolidation, you need to debit it. You understand? So this is the reason why we got the pro forma journal entry to be debit share capital 80,000, debit retained earnings 26,000, credit investment 148,000, then the balancing figure debit goodwill of 42,000. So the profit in B has turned out to be the goodwill. Guys, do you understand this? I don't mind to do it again. Do you understand this? Any transaction you process with somebody you are in the same group with, you need to eliminate that transaction. Make the debit credit, make the credit debit. How would you know which one to make a debit or a credit unless you know what you process? Let's do another example. Let's assume that I'm a subsidiary, right? And because I'm a subsidiary and I have a parent company, at the end of the year, I need to pay out dividends, right? And I ended up giving or paying 10,000 Rand dividend to my parent company. What journal entry would a parent pass in their own individual financial statements? They have received dividends from a subsidiary. What is the journal entry? Someone to give it to me. What is a journal entry? When a parent company receives dividends from the subsidiary, what the journal entry in the individual books of the parent company itself? We are not talking about consolidations here. If I'm a company and I've received dividends, what is the journal entry? What do I debit? What do I credit? Melody, you know this. Give it to me. What do I debit? What do I credit? Just try. You don't have to. Just it's a learning platform. Try whatever. When you try something, you get it wrong. Then you learn from it. The more questions you answer, the more you learn. So if I get it wrong, I know, okay, the last time I said this, but this is what it is now. I know better. Okay, so Masoti is saying that in the individual financial, so I want the individual financial statement. Good, I like that. So Masoti says debit bank. Good, and why am I debiting bank? I've received dividends, I've received money, so I'm debiting bank. And what do I credit? I credit dividend income. Good. So debit bank of 10,000, credit dividend income of 10,000. Excellent. This is it. This is the entry that the parent will have passed in their own individual books. Now, what journal entry will the subsidiary pass in their own individual books? The subsidiary. What journal entry would they pass when they give out, when they pay out the dividends? So write the journal that the parent did. Write it somewhere in your book right now. Write it somewhere. Debit bank of 10,000, credit dividend income of 10,000. Write it in your book right now. Then now let's look at the subsidiaries books. What journal entry they would have passed. What would the subsidiary pass when they pay out a dividend to a holding company? What would they say? Or what was the journal entry? Okay, so Melody is saying they will credit bank. Excellent. So they will credit bank because they've paid money. So the subsidiary will credit bank of 10,000. And what would they debit? They will debit retained earnings. Good. They will debit retained earnings. Why? Because dividends come from retained earnings. Don't they? They do. You pay dividends out of retained earnings. So debit retained earnings, 10,000. So write this also down. So now you have the entry that the parent passed of debit bank of 10,000 and credit dividend income of 10,000. Then in the subsidiary, you have an entry of debit retained earnings 10,000, credit bank of 10,000. And these are correct journal entries to pass in the individual financial statements of the parent and the subsidiary. It is only in consolidation that we have something called elimination. Because when it comes to consolidation, we say now we are one and the same company together. So therefore, you cannot transact with each other. So eliminate yourself, eliminate whatever transaction that you passed. But if it's not consolidated financial statement, then this transaction we just did is a valid, accurate transaction in the books of the individual companies of A and B. So now that we know what A did, we know what B did. Give me the pro forma consolidated journal entry. Eliminate it. How do I eliminate it? Give me the journal entry. How do I eliminate this transaction during consolidation? After I've joined the assets and liabilities and income and everything together, what is the journal entry during consolidation for this transaction? Dividends. Anybody? Zinzi, you haven't spoken. Anybody? During consolidations, what is the journal entry? Try it. Don't be shy. You learn when you get something wrong. I promise you. We said during consolidation, what do? We reverse what has been done. So give me the journal entry which shows that I've reversed this transaction. Anybody? You can say it or you can write it. So Melody says debit dividends. Say good. So Melody says debit dividends income of 10,000 and credit retained earnings. Excellent. That is the answer. This is your answer. This is your answer for 5. Unisa, this carries about 4 marks. Because in accounting, it's all about the principle. You understand. You understand it. So now you are not just passing pro forma journal entry by just learning it off by heart. You understand why. And you see that every single question that you do is like this. What did A do? What did B do? Let me reverse it. And I get my pro forma journal entry. So what you have said is full 100%. Debit retained earnings or debit dividend income and credit retained earnings. Because you initially, what did you do? You debited retained earnings, and you also credited the dividends income. Now swap it around. when you are preparing pro forma journal entry, swap it around. Whatever was a debit becomes a credit. Whatever was a credit becomes a debit. You have eliminated the transaction. Is that easy enough? Does everyone understand this, guys? We are moving on. One more answer, hands up, to say we must do one more example. Must we do one more example? Okay, let's do one more example. So let's say I give a loan, right? I'm giving a loan to my subsidiary, right? My subsidiary needs money and I'm giving them a loan. What is the entry in the parents' books if I give out a loan to my subsidiary? What is the entry? The journal entry in the parents' own books. What is the journal entry for a loan? Debit what, credit what? Akani, I'm giving a loan to my subsidiary. What is the entry that the parent company will pass because they've given a loan? If you go for the bank and you get a loan from Standard Bank, what entry will you pass as a company? Maybe Standard Bank has given you, or maybe you have given, yeah, let's say, okay. Yeah, if you are Standard Bank and you give a loan to a company, what journal entry will you pass? So when you are asked to give a journal entry, right? Think about the substance of the transaction. I'm giving out a loan. If I'm giving out a loan, what am I doing? What am I doing? Okay, Masoti has helped us. She said our credit payable subsidiary and debit bank of parent. I'm giving, okay, so I don't know if Masoti is talking about the one with the bank or he's talking about a parent company giving a loan to a subsidiary. So let's say a parent company is giving a loan to a subsidiary so that it is clear. Forget about the bank. The parent company is giving a loan to the subsidiary. What would be the entry? The holding company or the parent company is giving a loan to the subsidiary. What is the journal entry?
So, because the parent has given in its own book, it will have increased its creditors.
Good.
So we will.
Okay, so wait, no, pause. Slowly. I'm writing it down. So in his own book to say credit a payable, right?
Yes.
Yeah.
Yes, because it has increased.
I'm writing it down. Then we'll analyze it. Ne? So credit
Yes.
a payable. Let's say 100,000. I'm writing it down. And then what do I debit? This is for the parents' own books. Okay. What do I debit?
Oh, I cannot debit the bank, so that's one because money has left the
Good.
bank.
So correct
So meaning
yourself.
that we
Okay.
yeah. So meaning that we will credit the bank because money has left the bank.
Good. Excellent. You are thinking about it. So credit a bank of 100,000. Yes. What do I debit?
And you debit
Yeah, no, say it. I think, well, have we lost myself? So I credit a bank because money has left me. I've given the money to my subsidiary. Money has gone out. So I credit a bank. I credit cash or credit bank. Then what do I debit? What do I debit? Anybody? Oh, okay. Leon, okay. Oh, Leon has helped us. Sorry, I didn't see. So Leon said credit bank, good. Credit bank and debit loan to subsidiary, good. What is that loan to subsidiary? Is that an asset or a liability? To the parent company, is that an asset or a liability? The loan to subsidiary, what is it? Is it an asset or is it a liability? Leon, is the debit loan to a subsidiary an asset to the parent company or is it a liability? It's an asset, good, it's an asset. Melody answered, it's an asset. So whenever you give a loan to somebody, right, what are you doing? Just think about it. I'm giving a loan to someone. I've taken my money out and I've given it out. So I mean, money has left my company. So I've credited bank, right? Good. Now, at the same time, the fact that I've given a loan means that I must record the right to receive that money back. And that right to receive something is what? It's an asset. What is an asset? It's a resource controlled. You control it. You have got the right to receive that money back at some point, maybe after 5 years, after 10 years, depending on the term of the loan. So when I've given a loan, I've taken it's credit my bank, right? But I also debit an asset because I have the right to receive this money back at some point in the future. So I credit loan to subsidiary or loan assets, however you want to describe it. Good. So now we know what happens in the book of the parent. What about the subsidiary? So write this one down. Debit loan assets or debit as loan to subsidiary, and credit bank. That is what the parent company will have done. Let's say 100,000, 100,000. Now in the subsidiary, what would the subsidiary do? What entry will they pass? In their own individual financial statement, they have received a loan. Just like when you receive a loan from a bank, you have, in this case, you have received a loan from your parent company. What is the journal entry? I'm giving you guys time to think because I know you guys are people who like to think. Yvonne, welcome. When I give a loan so if I'm a subsidiary and I've received a loan from my parent company, what is the journal entry? Anyway, welcome. What is the journal entry? I've received a loan from my parent company. What is the journal entry? We know what happens in the parent own books. They debit a loan to subsidiary of 100,000 and they credited bank of 100,000. Now the subsidiary, what would they do? Now that they have received the loan. Okay, Melody has helped us. Melody said debit bank and credit loan liability. Excellent. That's what you have. You have received a loan. What is the loan? It's money. So to the subsidiary, it's money. They've received money. So debit bank. And what do you credit? Credit a liability to tell us that at some point after 5 years, I need to pay back this loan. It's a liability. So I debit bank and I credit a loan liability. So now that I know what happens in the parent company, and I know what happens in the subsidiary, what is the pro forma consolidating journal entry? Someone must give this to me. I know what happens in the parent company. I know what happened in the subsidiary. What is the pro forma journal entry that I must pass during consolidations? Can either talk or write it, whichever one is faster.
I think in the consolidation, you'd debit the loan liability and credit the bank.
Take your time. I'm slowly. Debit loan liability, 100,000. Credit what?
The bank.
Don't touch bank. I always say, don't touch bank. What do you credit? Debit loan liability and credits. Yeah, you debit the loan liability and you credit the loan assets or the loan to the subsidiary. So you credit the assets and you debit the liability. You've reversed the transaction. You've eliminated it. You've made whatever was a debit a credit and whatever was a credit a debit. But don't touch bank. You see how easy pro forma consolidation journal entries are. You see how easy it is. All I need to do is to understand journal entries, pass the journal entries in the parent company, pass the journal entry in the subsidiary, and cancel them out. Whatever was a debit make it a credit. Whatever was a credit, make it a debit. And you are done. 5 marks or 10, depending on how many pro forma journal entry they ask you to prepare. There is no way you should get more than 90% for consolidations. I promise you. Because the first stage is that I combine the two. I combine the assets, liabilities, equity, income, and expenses on a line-by-line basis. Even grade 1 child can do it. Add A plus B. Then after, eliminate it. How do I know which one to eliminate? I pass the entry in the parent. I pass the entry in the subsidiary. I cancel that entry. And you are done. But when you are the entry that the parent did, that one is your workings. You don't show it as part of your answer. Your answer is just the reversal. The reversal becomes your answer. So either you do it in your head or you write it on a piece of paper as your rough work, and then you cancel them out. You turn the debit into credit. You turn the credit into debit. But don't touch bank. Leave bank. You see how easy pro forma concept? Yes.
Quick question.
Yes.
When now you consolidating, as you said, the parent gave the subsidiary a loan.
Yeah.
And then when you now do a consolidated on the, you do the reversal. But now
Yes.
how will you be able to tell the difference between the receivable in terms of the inventory they sold and the receivable for the loan? Because those are operational inventories, they what they sell on their day-to-day basis. And then what the loan maybe it was for maybe other activities, or is it one and the same thing?
Okay. No, I got lost somewhere in your question. Are you saying that you're gonna struggle maybe to differentiate between a loan, as in the loan that a parent is giving a subsidiary, and then if there is maybe a sale of inventory between the two?
I'm saying if I have receivables in terms
Yeah.
of the inventory that was sold on credit, that is a receivable, right?
Yes.
So
Yes.
now when I write it down now, like now I'm noting it down, I'm doing the journal entry now, reversing as the parent.
Yes.
I gave them a loan. So
Yeah.
on the loan now, I want to say, do I credit receivables? Hence, I
Okay.
credited the bank because I thought, do I credit receivables? Then how do I then tell the difference between, or the marker tell the difference between the inventory receivables and the receivables of the loan? Or is it
Okay.
just one and the same thing?
No, okay. And this is not a difficult question at all. So all you need to do is that when you are writing down your journal entry, just make it a bit clearer. So if it's a loan, just say debit a loan receivable and credit a loan payable. When you sell, when there's a sale between a subsidiary and a parent, or vice versa, a parent and a subsidiary, you don't say that receivable becomes what? It's account receivable. You don't say a loan, right? That is account receivable. So that's how you'll be able to differentiate between the normal receivable from the day-to-day activities of the company, and from like a once-off loan that has been given to the subsidiary. It's based on, so it's based on the description, how you describe it. So just say loan receivable, loan payable. Then when it comes to like a sale of inventory, you say debit accounts receivable. So when you say accounts receivable, everybody knows it's not a loan, right? It's not a loan. It's actually it's a sale. Yeah. So just make your description.
And they're both receivable assets.
And sorry, and they are both
Receivable assets.
Yes, they are both receivable
Okay.
assets. Yes, they are both receivable assets. Yes, yes, they are. They are. You see how easy consolidation is. Many people don't know this. They learn it off by heart and they make mistakes. But all you need to do is that what did parent do? What did subsidiary do? Reverse it. And you are done. Good. Cool beans. So now that we've done we've done, so this is it. In the purpose of this course, That is all. That is the only transaction that you eliminate. You eliminate a loan, you eliminate dividends, you eliminate maybe profit on sale. We'll do that. Don't worry about that. It's easy. Good. So let's continue. Yeah. So that is it. Cool. So in our question, this is property, plants, and equipment. We've given property, plants, and equipment, investment, trade and other receivables. I'm hurrying up because we are below schedule. Share capital 180, retained earnings 120 and 60, trade and other payables 178, 130. Then they give us additional information that we should that A Limited acquired its interest in B Limited on 1 January 20.5, right? And meanwhile, we are, this is the financial statement as at we date 31st of December 20x6. That means A acquired B 2 years ago, or yeah, they acquired 2 years ago, because you have 2020, the whole of 2025 and 2026. So you since A acquired B, they've been operating for what? For 2 years. This is very important. Yesterday I said, as you read the question, mark the date of acquisition. Mark the date that the financial statements are being prepared. And look at how long, and look at the retained earnings and everything. Good. Yeah, so they tell us that on that date, 1 January 20x5, when A acquired B, the retained earnings was 26,000. So, and we take the retained earnings at the date of acquisition. We take the share capital of what? The date of acquisition. So the net asset, so you buy into the net asset value at the date of acquisition. Not any other date. So in the question, sometimes UNISA can trick you. They can give you so many dates, whatever, and tell you that prepare the pro forma journal entries. So if you don't know that you must only account for or reverse the net asset value only on the date of acquisition, you will get it wrong. So the share capital and the retained earnings has to be what? The acquisition date amount, not any other amount. You cannot take the amount in the income statement retained earnings of 60,000. No, this 60,000 is the 26,000 at acquisition plus other income that has been earned for the 2 years. That is giving us the 60,000. That is retained earnings for 60,000. You understand? So it's the 26,000 at date of acquisition plus another what? What is 60 minus 26? It's about what? Is it 34,000? Yeah, worth of income that you have earned over the 2 years, right? Yeah. So 60 minus 26,000, the 60,000 retained earnings that we see in the financial statement and the 26,000 at acquisition, the difference of 34,000 is how much income you have earned since A acquired B. Does that make sense? Good. They say at the date of acquisition, consider the carrying amount of the assets and liabilities to be equal at fair value because of FS3. Good. And now they give us the statement of profit and loss and other comprehensive income. Profit from operation 25 and 30. Dividends received. Aha. Dividends received from subsidiary. This is a wholly owned subsidiary, and you have received 10,000. That means, what does that mean? It means that every dividend that the subsidiary paid, they paid it to the parent company because I have 100% shareholding in the subsidiary. If this was a partly owned subsidiary, chances are the subsidiary will have paid 10,000, but maybe 80%, if it's an 80% ownership, 8,000 will have gone to the parent and 2,000 will have gone to non-controlling interest. Do you understand? So if this is a partly owned subsidiary, it means that the 10,000 that was paid by subsidiary, 8,000 will have been received by the parent. Only 8,000 because it's a partly owned. You only own 80% of me, and the 2,000 or the 20% will have gone to the non-controlling interest, NCI. But because in this case it's a wholly owned subsidiary, 100%, all the 10,000 that was paid gets paid to the holding company or the parent company. Good. Then we have profit before tax, 35.23, tax of 11 and 7. Other comprehensive income, there's nothing. And then we have total comprehensive income. Then we have statement of changes in equity. We have our share capital and retained income. Statement of changes in equity start off by opening balance, then the movement, profit for the year, then dividends paid, 15,000, 10,000. So you see, the holding company also paid some dividend to its own shareholders, right? And then the B Limited also paid 10,000 to its own shareholder. Who is the shareholder of B? It's A. So they paid everything to A. Good. Now required. Prepare the consolidated statement of financial position and other comprehensive income and consolidated statement of changes in equity as at 31st of December 2020 in compliance with international financial reporting standards. So, and look at the analysis. So you start off by saying analysis, share capital 80,000. So in the analysis, you always have what? A total column and then that of the parent. If it happens to be a partly owned subsidiary, you divide the analysis into two. You have the part that goes to the parent if it's an 80% holding, the part that goes to the parent, and the other that goes to what? The NCI, the non-controlling interest. So, but in this case, it's wholly owned, so everything goes to the parent company. Share capital, 80,000. Retained earnings, 26,000. Total, 106,000. What is 100% of 106,000? It's 106,000. Equity represented by goodwill. But meanwhile, so the net asset value on date of acquisition was 106,000. Meanwhile, I paid 148,000 for the net asset value. So the difference of 148 and 106 gives me what? Is goodwill. And the thing about goodwill is that only the company that controls must recognize the goodwill. If you don't have control in that company, you cannot recognize goodwill. Write it somewhere. Put it somewhere in your mind. The only company that recognizes goodwill is the one that controls. If you don't control, you cannot recognize goodwill. Good. Then here you have since I acquired it to the beginning of the financial year, telling me what my retained earnings. So this part of the analysis since acquisition to beginning of the current year is what? My retained earnings. So how did I get the retained? Remember, the 26,000 that was there when A came to acquire B. That 26,000, me as a parent company, I did not take part in it. It's not mine. So I don't share in that retained earnings. That retained earnings was earned by B Limited and B Limited alone. Because at that point in time, I had not acquired B yet. So that 26,000 is not part of the consolidations. So that is why in calculating the 28, it is the 26,000 minus 54,000. How did I get the 54,000? In getting the retained earnings, it is the 26,000 minus 54,000. How did I get the 54,000? Where is the 54,000 from? Where is the 54,000 from? The 54,000 from here is the opening balance of B Limited. Remember, this is basically the retained earnings of B Limited. So you subtract the 26,000 that was at acquisition, retained earnings, minus the beginning retained earnings, 54, to give me what? The 28. This is a bit complex. Does everyone understand this? I'm calculating the retained earnings, and I'm saying it is the difference between the amount at the date of acquisition to the amount, or the difference between the amount of retained earnings at date of acquisition and the amount at the beginning of the new financial year. That gives me what? The retained earnings that I can take part in. Does this make sense? I'm calculating retained earnings. I'm calculating retained earnings. The retained earnings is the difference between the retained earnings at acquisition. Before acquisition, I do not take part. At that time, A have not acquired B. So I don't have any right to partake in that retained earning. The 26,000, I don't take part in it. The ones I take part in it are the retained earnings subsequent to the date of acquisition, from the 26,000 to what I've earned to the 54,000. That part, I'm part of it. But before then, I do not take part in that. And that is why it's only the difference between the 26,000 and the 54,000 is what comes as retained earnings in the consolidated financial statements. Does this make sense? Is this clear? I don't want you to go and sit by your desk and then you don't know what to do. Like where did this come from? Where did this come from? Good, cool. So
just a quick question.
Yes.
In some instances, you find that you are given the financial statement of position and it's at the end of the year only. And then that retained earnings, you're not given retained earnings at the beginning, but you are given retained earning of the subsidiary at acquisition. Do we still then take the retained earnings at the end and deduct the retained earnings that we found the subsidiary with?
No, you can't do that. You can never do that, because then that is not retained earnings. That is not retained, because that is just retained earnings at the date of acquisition, and then what I've earned from the date of acquisition until the end of the year. The question has to give you the opening retained earnings for you to be able to calculate the retained earnings. If the question doesn't give it to you, there's no way you can be able to find that out. There's no way. So there has to be something in the question to give you an indication of what the retained earnings is. They will give you that there will be a clue to guide you for you to be able to calculate the difference between the retained earnings on the date of acquisition and the amount at the beginning of this new financial year, for you to be able to calculate the retained earnings for the consolidated financial statements. There will be. I've never seen a question like the way you have, like they will never do that to you. No. If that is the case, then then it's not retained, and then it becomes income then. Yeah, but they will give you information for you to calculate the retained earnings. Okay. Any other questions? Everything we're doing here, right, is the same thing for study unit 5. Just that instead of a wholly owned, study unit 5 is partly owned. So that one, you split everything between the parent and the non-controlling interest, NCI. That is why I'm taking my time, because if you understand the principle here, you also understand it. The same thing apply for study unit 5. Any questions? Cool. All right. So so we were moving on. We saw the analysis. We saw we've calculated the goodwill. We've calculated the retained earnings to be 28,000, which is 54 minus 26, and we said it is 100%. So 28,000, everything goes to the parent company. Then we have current year. Current year, the profit is 16,000. How do I know that the current year profit was 16,000? I look at the statement of profit and loss and other comprehensive income. 16,000 here. 16, the profit for the year, 16,000. So that's how the 16,000 came about. And then the dividends. Dividend paid. I look at the statement of changes in equity. It was 10,000. So always in the analysis, it's always about the figures of the subsidiary. It doesn't touch the parent. Whatever you do in the analysis is the amount for the subsidiary that you do, that goes into the analysis. Good. So then you have profit for the year. So current year 16,000, profit, and then dividend pay. I think it's a bit misaligned, but dividend paid is 10,000. All the 10,000 goes to the parent company. So that means at the end of the year, your net asset value for the holding company is 148,000, and I mean it's 148 or it's 148,000. Good. Now let's look at the pro forma journal entry. So the pro forma journal entry, like I said, so basically, yeah. So let me qualify something here, and maybe I said. So a pro forma journal entry is basically the journal entry that takes the individual financial statement of the holding company and the subsidiary into a consolidated financial statement. Without a pro forma journal entry, you will not be able to you will not be able to prepare the consolidated financial statement. So the pro forma journal entries helps you to prepare the consolidated financial statement. You take the balances in the parent and the subsidiary, you join them together, and then you adjust the amount using the pro forma journal entries. So let's look at the pro forma journal entries. You debit share capital 80,000. We know why. We debit retained earnings 26,000. We know why. We credit investment of 148,000. We know why. Then this goodwill of 42,000 is not a reversal. This one is not a reversing journal entry. You are recognizing goodwill. So it's a recognition adjustment. You are recognizing goodwill in the consolidated financial statement for the first time. Goodwill. So only the share capital you reverse, retain earnings you reverse, investment you reverse. But when it comes to the goodwill, which normally it becomes the balancing figure, it's not a reversal. You don't reverse anything. It's a recognition. You are recognizing goodwill for the first time, and goodwill is an asset. So you debit goodwill of 42,000. Goodwill is always an asset. You can never have a negative goodwill. If you have a negative goodwill, the standard of IFRS 3 says that you recognize it in the profit and loss as an expense immediately. So when you happen to buy a company less than its net asset value, we call it a bargain purchase. You've made a loss. That loss goes into the profit and loss statement immediately as an expense. Good. So at least the more I repeat, and then let's look at the dividend. So this also what another pro forma journal entry. You are eliminating that journal entry. So you debit dividends received or dividend income of 10,000. You credit dividend paid of 10,000. So when you go to the line that says dividends, you add the dividends of A, you add the dividends of B, and then you apply this pro forma journal entry by debiting the dividends of 10,000, and you get your final answer. Let's look at it. So now that we've done our pro forma journal entries, let's look at our consolidated profit and loss. Profit before tax 35,000 plus 23,000 minus 10,000. Where is this 10,000 coming from? Profit before tax, you add the profit before tax of A, 35,000. You add the profit before tax of B, 23,000. Where is this minus 10,000 coming from? Who can tell me? It's the dividend. It's the dividend. Good. Why? Because the parent company will have added that dividend into their profit before tax. But guess what? Upon consolidation, that profit, that dividend does not form part of your profit because it has to be eliminated. So because of the pro forma journal entry that you passed to eliminate that dividend by debiting the dividend received, that is why this 10,000 minus 10,000 is here. You see, I'll repeat again. This 35,000 here belonging to the parent company, it includes the 10,000 rand of dividends. But you know from your knowledge that dividends must be excluded. It must be eliminated. So you eliminate it, you bring it out. Minus 10,000. this figure here, it will give you a lot of marks. We don't, when we are marking, we don't joke with it because a lot of thinking went into this. So you added 35,000, you added 23,000, but bringing the, being able to know, to remember to bring the 10,000 out. But you remember why? Because you passed a pro forma journal entry, and that pro forma journal entry must be applied to your financial statements. So you must minus 10,000 to get 48,000. Income tax, 11,000 plus 7,000. There was no pro forma journal entry pertaining to income tax. So you leave it as it is, 18,000. Profit for the year, 30,000. Total comprehensive income, 30,000. Good, you are done. Now let's look at the statement of changes in equity. Consolidated statement of changes in equity. The balance at 1 January 2020 it was 100,000, right? Why is it 100,000? Because it was, the A was 100,000, B was 80,000, making 180,000. But the pro forma journal entry, it eliminated that 80,000. Look at this pro forma journal entry here. It eliminated this journal entry. You said debit share capital. So 100,000 plus 80,000 minus 80,000 gives a share capital in the consolidated financial statement of what? 100,000. 100 plus 80 minus 80 gives 100,000. And that is why in your consolidated statement of financial statement of change in equity, the share capital is only 100,000 because you have you combined them, you added it 100,000 plus 80,000, but then you deducted or you eliminated the 80,000 from it. So 100 plus 80 minus 80 gives 100. So share capital becomes 100,000. Retained earnings. So you also combine the retained earnings at the beginning of the year. At the beginning of the year, what was the retained earnings of the period? It was 111,000 plus 54,000. Then you made, then there was what? A pro forma adjustment of minusing it by 26,000. So let's do the math and see. 111,000 plus 54,000 minus 26,000. What do you get? 111,000 plus 54,000 minus 26,000. You get 139,000. Is that what we got? Yes, 139,000. So this 139,000 is the 111 from the A Limited plus the 54,000 of B Limited. You've combined it. Like I said, the first thing is to join the two. Then, but because of the pro forma journal entry of debiting retained earnings of 26,000, you minus 26,000. Then you get what? 139,000 at beginning. Then you bring your profit for the year 30,000. Then dividends paid. The dividends paid, why is it only 15,000? Because dividends paid, you added dividend paid of A, 15,000, plus dividend paid of B, 10,000. But there was a pro forma journal entry to credit, to credit the dividends paid. And that made it 15 plus 10 minus 10, giving you 15,000. That is why in the statement of changes in equity, we only have dividend paid of 15,000. Does that make sense? So the pro forma journal entries are very important. So if you don't know what to eliminate, you are not going to get your consolidated financial statement right. So after you have joined A and B together, now you come to eliminate. So you must know. So once you are then, so it's a pro forma journal entry that helps you to eliminate them, then to get the right final answer. Let's look at our statement of financial position. Property, plants, and equipment, 160 plus 180. We didn't prepare. There was no pro forma journal entry for property, plants, and equipment, so we leave it at that. But don't forget, we recognize goodwill of 42,000, so it comes here 42,000. Trade and other receivables, it was 90,000 plus 90,000. We never did pass any pro forma journal entry for trade and other receivables. So the answer is 180,000. And so on and so forth. Share capital from the statement of change in equity, share capital was 100,000, only 100,000, we bring it here. Retained earnings from the statement of change in equity was 154,000. That is it. Trade and other payables 178 plus 130. There was no pro forma journal entries pertaining to trade and other payables. So the answer remains 308,000. Any questions, guys?
Yes, sir.
Yes.
On the on the consolidated statement of just go up again.
Yes.
Just up again. On that profit there, in the events where it is, because I normally rely on the analysis now to get that profit, and I see how you're doing it so easy. But now I want to understand on this amount of profit on the how would I then go about to obtain that amount without going through the long route of the analysis?
Oh, are you talking about the 30,000?
Yes, because I normally rely on the analysis to get that amount. And not only that, because sometimes if it's 100% owned, then I would know it's that whole amount. But sometimes it's 70% of that.
Yeah.
Then how would I go about finding that profit without going through the analysis as well as on the page below? Just scroll down. This is now the second question. Scroll down on the retained earnings.
Yeah.
That amount as well. That 154.
Yeah.
That amount also, I also use I rely on the analysis to get that amount. So I don't want to do that anymore because I realized how much time I'm wasting, and I'm not even getting any marks for that time. So I just want to make sure that I'm able now to just go through it and just consolidate without wasting time. Thank you.
Okay, thank you. These are two powerful questions. Okay, so let me so the profit for the year 30,000. How will you be able to get a profit for the year 30,000 without doing the analysis, since the analysis actually wastes your time? So if you'll be very lucky if the question says prepare the consolidated financial statement of financial position, prepare the statement of changes in equity, and prepare the statement of profit and loss and other comprehensive income. So if the question asks you to prepare the statement of profit and loss and other comprehensive income, you take the 30,000 right from the statement of profit and loss and other profit and other comprehensive income. You take it from there. Remember, this 30,000 is coming from the statement of profit and loss and other comprehensive income. In fact, that is what it is. This now 30,000 is not coming even from the analysis. It's coming straight from the income statement, from the profit and loss statement. So the easiest answer to your question is that then quickly do a calculation of the income statement. Say, okay, profit from A, 35, B, 23, okay, minus the dividend received 10,000, I get 48. There was tax 18, 30,000. I write it there. So do an income statement in your head, or write it on a piece of paper, like a rough income statement. Profit, tax, let me put it there, without going through an analysis, because basically this 30,000 is your profit for the year on the income statement. Don't waste your time on the analysis. That is yeah.
But then is for a fully this whole is for a fully owned subsidiary.
Yeah.
But if it's not fully owned subsidiary, then I'll then take the 30% and multiply by 70% to obtain. Okay.
Yes. Yeah.
Okay.
No. You said what? If it's a wholly owned subsidiary, sorry. If it's a partly owned subsidiary, what will you do again? You take.
Then I would take that whole profit, which is 30,000, and multiply it by percentage, and then plug it in there for the parent. Okay.
No. So what happens in a Wow, I like this. I like this question. I like it a lot. So what happens in a partly owned subsidiary is that, right? Even though it's a partly owned subsidiary, right? The only thing that is going to change is this 10,000 here. Because when it's a partly owned subsidiary, you still put together, you still add 35,000 and the 23,000. But the only difference is comes about on the 10,000, because the 10,000, you are not going to receive all the 10,000. A part will go to you. Maybe if it's an 80% shareholding, only 8,000 will have been included in the 35. So you only subtract what? 8,000. But other than that, everything will be the same. Everything will be the same. So when you are dealing with consolidations, so there is this, and then there's partly owned instead of unit 5 that we didn't get at. Look at this question for a partly owned subsidiary. The only everything is the same as this, except that the 10,000 here has been split between NCI and the parent company. So don't be too smart and say, oh, it's 30,000 times 75%. No, it doesn't work like that. It should not work like. But if you look at the analysis, right? Let's go to the analysis. Is it the analysis? Yes. Yeah. Okay. So the analysis will have profit current year 16,000, right? The 16,000. Okay. So so this is what you mean. So if this was an 80% holding, the 16,000 will be 16,000 times 75%, right? This is what you are saying. No, but no. It's not like that. It's not like that. Even when it's partly owned, you still consolidate the amount fully. You still consolidate the amount fully. The only time that this thing will change to multiply by 75% is when there's a dividends of 10,000. Then you split it between this to say maybe 75%, then 7,500, and then 2,500. But when you are consolidating, you consolidate the amount fully. Right? It's fully. Okay. And then the statement of the beginning of what the 154,000, this 10N is also coming straight from the statement of changes in equity. So if you prepare the statement of changes, or you do a rough calculation of the statement of changes in equity, you will be able to get a 154,000. It's coming straight from the statement of changes in equity. It's the beginning amount plus the profit for the year minus the dividends. So you get a 154,000. I want you to look at a partly owned, and then just look at it. Yeah. The only difference that will come during consolidation for a partly owned is when there is a dividend and you have to apportion it. But if it's that you will add all together. You add all together. Does that make sense? I don't know if I'm actually saying the right thing. Does that make sense? Or you still not getting it?
I'm definitely going to try it the way you're doing it and see, because I see that I was just complicating my life. I'm going to do it the way you're saying it, and then if I have any challenges, I'll contact you.
Yeah, if you have any challenges, yes. If you have any challenges, let me know. If you have any challenges, just let me know. Everything that we have done, the principle is the same. The principle is the same. right? So just go and try everything we have done. Just that this is a wholly, this is a partly owned subsidiary, but there's no difference to what we have done. Property, plants and equipment, 200. Investment in Y, 30,000 shares, but I bought it for 152,500. Everything is the same. Retained earnings 50,000 for 40,000 shares. You calculate your shareholding, right? So you have your shareholding to calculate. Then you have your gross profit, you have your dividends received, and so on and so forth. Everything is the same. So I want you to go and try partly owned subsidiary. By the partly owned subsidiary and see how that plays out as well, and see how that plays out. Oh, sorry, who was asking me the question? Was it Melody or Masoti? So you were saying that, well, when it comes to the profit, will you apportion for a partly owned subsidiary? Is that what you were saying?
No, I was saying in terms of not going through the route of using an analysis to consolidate for the statement of profit and loss and the statement in change of, especially where equity and retained earnings are concerned.
Yeah, then
So,
then you have to do so. Yeah, so the trick there is that you need to do an income statement calculation in working, where you say, okay, profit is this. What shareholding do I own in this? 75%. Okay, so the profit 30,000 plus 75%, and then if maybe it was earned from the particular month, a particular month, I apportion it. So instead of going through the analysis and say, okay, 75%, it's 80. So let's go here. Let's go down. Okay, like this, right? Retained earnings. The total is 20, but because it's a 75% holding, you spread it out. So you split it between 15,000 and 5,000. So in the same way, in your calculation, right? Also multiply it by the percentage holding to get your answer. But the thing is that you must be very careful when it comes. The only time you apportion is in the income statement. But when it comes to the asset and liabilities, and equity, you add them. You add it as a whole. There's no apportionment. You understand that? Because it's consolidation. So when it comes to the income statement item, retained earnings and income, and that you multiply by the percentage holding. So if it's a 75% holding, you multiply by 75 for the dividend, for the retained earnings, for the profit. But when it comes to the asset and liabilities and equity, those you consolidate them 100%.
Just look at on the profit for the year, that 52,500, and then if you scroll down to the financial statement of position,
okay,
52,500. Okay, just some more.
Okay.
Up until we get to the consolidated statement of.
Okay. So is it here? Is it here?
There's no finance. Is it just that there's no consolidated financial statement of position?
Okay, there's position. Okay, I think there's position. There is position. Yeah, there's position here. Yes.
That retained earnings. How did they get the 330,000?
The retained earnings 330. Okay, so so the retained earnings is first of all, this number is coming straight from the statement of changes in equity. So let's go to the statement of changes in equity. So if you want to get this number, then you have to do a calculation of the statement of changes in equity. Basically, that is it. That is if the question does not ask you for the statement of change in equity and just ask for the statement of financial position. For you to be able to get this number to write the 330,000, you need to do a rough calculation of the statement or you need to compute, which is not part of the answer, but you need to on your workings be able to compute or know how to compute the statement of and get that number and get that the retained earnings by doing a rough calculation of the statement of changes in equity. So you start off by saying, okay, balancing figure. So you start off by saying retained earnings beginning of the year 225. From that, you know that there was a profit for the year of 125. And the thing with consolidation that's also very good is that we do what is called a consequential marking. In other words, we don't penalize you twice. So if maybe in the statement of profit and loss you got this 125 wrong, if you carry it through your workings, we assume we mark it through. We don't penalize you 2 times. You understand? So whatever your answer was, and maybe let's say it was wrong, when you come to the calculation of the retainers, we will not mark you wrong, provided that you carry through whatever that you got, whatever wrong answer or right answer you got in your profit and loss, you brought it here in calculating the balance of the retained earnings. You understand? So all that you do is that you get a rough calculation of your retained earnings at the beginning, 225. Then it's okay, profit for the year, 125,000. Dividends paid, 20,000. I get my answer, 330,000. But it comes with practice, and the speed also comes with practice. Because for example, I would know that for me to get a retained earnings, there are 3 things. There's the opening balance, there's profit for the year, there is dividends. So by knowing that, it makes you quicker. Yes.
However, that 15,000 is from the analysis.
The
210 plus 15 that gave you the opening balance of 225. That is now from the analysis, the 15,000.
Okay, so I don't need to do an analysis to get this. I don't need to, because all that I do is that I take the retained earnings of the parent, right? Beginning retained earnings of the parent, and I also know from my calculations what my retained earnings, my opening retained earnings is, right? Well, you see, as we go through this, as we go through the consolidation, you will see. I'll be showing you how to do these things. We were taught when we were studying that don't use analysis because it takes it wastes time. So we were guided or we were helped as to how to get the things very fast. So as we go through this, I'll show you how to do it. That you don't have to waste your time. Yeah, you don't have to waste your time. But it also comes with understanding the principles. Understand the principles. Okay, guys, hey, like we are so much over time. Okay, so guys, any one more question? No question. Okay, all right. So the lady, I think we are done.